Hello friends, this is Victor here. Welcome back to the Intelligent Investor channel. In today's video, I'm going to analyze ServiceNow stock. I'm going to talk about why I believe ServiceNow is one of the best software stocks over the long term. As always, I like to give you more context first. At the time of making this video, ServiceNow has already become one of the largest software as a service SaaS companies in the world, just right behind Adobe, Salesforce, SAP, and Intrinsic. In fact, ServiceNow has become one of the fastest growing software companies in recent years. When it comes to revenue growth, ServiceNow has been growing much faster than Salesforce, Adobe, SAP, Intrinsic, and even Palantir in recent quarters. I will talk about ServiceNow's expected growth rates throughout this video. In terms of performance, ServiceNow has done very well compared to the S&P 500. For example, ServiceNow outperformed the S&P 500 by a good margin over the past 1 year. ServiceNow also outperformed the S&P 500 by a very large margin over the past 5 years. Of course, past performance does not guarantee future results. We have to look forward instead of looking backward when we invest in stocks. So in this video, I'm going to analyze ServiceNow stock. I will explain why I believe it's one of the best software companies over the long term. I will explain why I think ServiceNow is even better than Salesforce and even Palantir. You will learn about these topics in this video. First, I will give you a quick stock portfolio update. Then I will talk about ServiceNow's business model, its biggest risk to consider, ServiceNow's long-term growth prospects, ServiceNow stock valuation, and where I buy ServiceNow stock. If you like this video, make sure to hit the like button, subscribe, and turn on the notification button. I will continue to make many excellent stock analysis and investing videos every week that will help you become a great investor. Each video usually takes me 20 to 30 hours to make, so if you like this channel and want to support it, check out my Patreon blog in the video description. Our goal is to help all our members become multi-millionaires through long-term investing. Once you become a premium member, you can follow all the stocks I'm investing for the long term, follow my personal stock portfolios, watch my investing tutorial videos, and download the latest intrinsic valuation models for all the stocks I'm analyzing, so you will know when a stock becomes undervalued, fairly valued, or overvalued now. Also, you will have access to all my latest stock ratings for all the stocks I'm analyzing. The link is in the video description. Take a look, let's start. Before talking about ServiceNow's biggest risk and long-term prospects, I would like to give you a quick stock portfolio update first. This is one of my portfolios. It's separated into 3 different accounts. This is the first account. This account is doing exceptionally well and it's outperforming the S&P 500 by a very large margin because I have invested in outstanding companies such as Microsoft, MasterCard, Visa, Amazon, TSMC, Google, ASML, Meta, and American Express. I bought them when they were much more undervalued before. Typically, once I find an outstanding business I want to invest in, I try my best to buy and hold it for the long term, so it can become a multi-bagger stock over the long run. Of course, this requires a lot of patience. It's not easy at all. This is the second account. Apple is my biggest multi-bagger stock. It's already a 12-bagger stock. In fact, Apple is one of my first stocks. I sold some Apple shares before, so this is all gains. I also have other multi-bagger stocks such as Google, Microsoft, and Visa. TSMC is almost a 2-bagger stock. I made the mistake of selling Nvidia for a quick profit too early before, so I bought back Nvidia earlier this year. This is my prediction. I expect Nvidia will eventually reach well over $4 trillion in market cap because of Nvidia's upcoming Blackwell platform. This is the third account. This account is newer than the 2 other accounts. I bought most of these stocks over the past 18 months, so it will take them some time to become multi-bagger stocks. I have bought and sold many stocks to make short-term gains in this account, so the cost basis is actually much lower. Last month, I made the mistake of selling my Broadcom shares for a quick profit too early, so I decided to buy back more Broadcom shares before making this video. This is my prediction. I expect Nvidia, TSMC, and Broadcom will be worth much more in the long run because they are benefiting the most from the current AI revolution. They provide the most important AI infrastructures and AI hardware that are needed to build the most advanced AI models. There will be many consumer and enterprise AI applications going forward. All the major software companies such as Adobe, Salesforce, SAP, ServiceNow, and Palantir will continue to introduce more AI applications that will likely transform many businesses, large enterprises, and government agencies. Going back to ServiceNow, let's talk about the company's business model and its biggest risk first. So what does ServiceNow do and how does ServiceNow earn its revenues? ServiceNow is an end-to-end intelligent workflow automation platform for digital businesses. ServiceNow's intelligent platform, called the Now Platform, is a cloud-based solution with embedded AI and machine learning capabilities that helps global enterprises across industries, universities, and governments unify and digitize their workflows. By connecting workflows across silo organizational functions and systems, ServiceNow's Now Platform delivers business outcomes, including unlocking productivity, streamlining processes, and improving experiences for both employees and customers. Now, to put it in simple terms, ServiceNow is a workflow automation company that helps businesses and government agencies automate their business processes, make their workflows more efficient, connect their systems across different silos to make them work better together, remove silos between different departments and businesses, increase employees' productivity by providing them much better workflow automation software that's powered by generative AI, and ultimately improve the experiences for both employees and customers. The end goal is to help businesses, large enterprises, and government agencies automate their workflows and improve their productivity. ServiceNow's cloud-based Now platform has these four major workflows: technology workflows, customer and industry workflows, employee workflows, and creator workflows. Here's the important part of ServiceNow's business. ServiceNow started off as an IT service management (ITSM) business. You can think of this as an IT help desk business. Now, ServiceNow has expanded to IT operations management, HR service delivery, IT asset management, security operations, customer service management, and even the app engine that allows developers to create their workflow apps on ServiceNow's Now platform. ServiceNow has also expanded to different industries that need workflow automation applications. I will talk more about this later on in this video. Let's go over ServiceNow's most recent financials here. At the time of making this video, ServiceNow has a very strong balance sheet. ServiceNow has $8.78 billion in cash equivalents and short-term and long-term investments. Just to compare, ServiceNow only has $2.27 billion in total debt and lease liabilities. ServiceNow can essentially pay off all its debts and lease liabilities in advance and still have $6.51 billion cash left. ServiceNow earns 97% of its total revenues from subscriptions. This is very important because it shows that ServiceNow has a very predictable revenue growth model. For example, you can see that ServiceNow has had very consistent revenue growth, operating income growth, free cash flow growth, and free cash flow margin growth over the past 10 years. The important part is this: ServiceNow has become much more profitable than before. ServiceNow is already earning consistent GAAP operating income that's expected to grow much more going forward. Also, ServiceNow's free cash flow margin is expected to be slightly above 30% going forward. ServiceNow is no longer issuing a lot of shares like before. This is good for shareholders. Typically, most SaaS businesses such as Salesforce and Palantir tend to issue a lot of shares, especially during their early growth stage, because they have to keep their employees well compensated or because they need to acquire other companies to stay competitive. Going forward, ServiceNow's management expects that the company's annual share dilution will be less than 1% of the outstanding shares. Also, ServiceNow's stock-based compensation as a percentage of revenue is expected to decrease much more to below 15% going forward. This will benefit shareholders a lot because it will increase ServiceNow's GAAP operating margin and GAAP operating income going forward. This is the first biggest risk we should consider. If you look at ServiceNow's 4P using 2024's consensus earnings estimate, ServiceNow's 4P is above 50. This is not cheap at all. If ServiceNow's EPS grows slightly above 20% each year over the next several years, it will take ServiceNow around 4 years for its PE to drop to around 32. This valuation method suggests that ServiceNow is likely overvalued now, but this is only one valuation method. I will show you how to calculate ServiceNow's intrinsic value later on in this video. Here's another risk we should consider. ServiceNow's biggest risk is whether the company can maintain a revenue growth of 20% each year over the next several years. ServiceNow's management expects that the company's subscription revenue will grow by around 22% year over year in fiscal 2024. This is a very high growth rate for a very well-established large-cap SaaS company. Over the longer term, management expects that the company's subscription revenue will grow at a compound annual growth rate (CAGR) of 20% or more through at least 2026. This expected revenue growth rate is much higher than most large cap SaaS companies such as Adobe, Salesforce, Intuit Inc., and SAP. Most SaaS companies' revenues are expected to grow at around 9% to 12% each year over the next several years. Wall Street analysts have estimated that ServiceNow's revenue should grow slightly more than 20% each year over the next several years. After that, ServiceNow's revenue growth is expected to slow down starting in 2027. Here's a very interesting comparison. ServiceNow has a much larger revenue base than Palantir. ServiceNow also generates much more operating profit and free cash flow than Palantir. ServiceNow's revenue is expected to grow at around 20% each year over the next 3 years. This is very similar to Palantir's expected revenue growth rates during the same period. I think this suggests that ServiceNow has a much better and more profitable business model than Palantir. Here's the biggest risk for ServiceNow. ServiceNow's revenue growth will eventually slow down like most other SaaS companies once ServiceNow becomes much larger. It's very hard for SaaS companies to maintain 20% plus revenue growth each year. It's more common for well-established SaaS companies to have 10% to 12% revenue growth each year. As I showed you earlier, ServiceNow's forward PE is quite high. I believe ServiceNow's current valuation would make sense if the company can maintain over 20% revenue growth each year over the next several years. In terms of competition, ServiceNow does have other major competitors such as Oracle, SAP, Salesforce, and Workday. Based on what I know, ServiceNow is the market leader in workflow automation. ServiceNow's Now platform is mission critical for many large businesses, large enterprise customers, and government customers. ServiceNow is used by most Fortune 500 and Global 2000 companies. For example, many major banks in the US use ServiceNow. Once customers use ServiceNow's Now platform and become used to it, it's very hard to leave the platform. This is why ServiceNow has a very high renewal rate of 98%. As far as I know, this is one of the highest renewal rates in the SaaS industry. This shows that ServiceNow's Now platform is very sticky for most customers. Here's another important part you should know. Compared to Salesforce, which has many small business customers, ServiceNow only targets large commercial customers, large enterprises and government agencies that have at least 100 million in annual revenue and have at least 1,000 employees. This allows ServiceNow to have very high quality customers that are willing to spend a lot of money on its platform. These large enterprise customers and government customers tend to be very sticky once they are used to ServiceNow Now platform. I think this is one of ServiceNow's biggest competitive advantage. There's another risk we should consider. It also applies to ServiceNow. About a month ago, Salesforce reported a much lower guidance than expected. In fact, Salesforce is expected to have the first ever single-digit revenue growth this year since the company went public. There are several reasons. The biggest reason is that many enterprise customers seem to be shifting their IT spending from traditional enterprise software to more AI spending. The second main reason is that many enterprise customers seem to be slowing down their IT spending because of the current macro environment or because they want to reduce their operating expenses. So this slowdown in IT spending is impacting Salesforce and many SaaS companies. Like Salesforce, many SaaS companies are also experiencing slower growth than expected this year. ServiceNow is one of the outliers in the SaaS industry. At the time of making this video, it's still growing much faster than most large cap SaaS companies. Let's talk about ServiceNow's long-term growth prospects. I will explain why I believe ServiceNow is one of the best software companies over the long term. You may have heard of the Rule of 40 before. The Rule of 40 applies to most SaaS companies. Typically, SaaS companies such as Salesforce, Adobe, and Palantir need to meet the Rule of 40 consistently for investors to consider them as great SaaS businesses. For example, if Salesforce revenue growth slows down to 10% a year, its EBITDA margin needs to be a minimum of 30% a year. And if Salesforce revenue growth slows down to 8% a year, its EBITDA margin needs to be a minimum of 32% a year. Here's the important part. The Rule of 50 has now replaced the Rule of 40. Only the best SaaS companies can meet the Rule of 50 consistently. Here's how it works. If ServiceNow's revenue growth is 20% a year, its EBITDA margin needs to be a minimum of 30% a year. This is a very good comparison. I think this suggests that ServiceNow has become one of the best SaaS businesses in recent years, even better than Adobe and Salesforce. For example, last year, ServiceNow was able to meet the Rule of 50. Adobe met the Rule of 40 and not the Rule of 50, and Salesforce did not meet the Rule of 40 at all. Going forward, ServiceNow's management expects that the company's subscription revenue will grow at a CAGR of 20% or more each year through 2026. This means ServiceNow's EBITDA margin will need to be a minimum of 30% to meet the rule of 50. ServiceNow's subscription value is expected to grow from $10.6 billion in 2024 to $15 billion plus in 2026. According to a recent interview, ServiceNow COO wants to grow the company's subscription value to as much as $30 billion per year by 2030. Of course, this is a very ambitious goal. This means ServiceNow will need to maintain a revenue growth of approximately 20% each year through 2030. If I have to make an educated guess, I believe ServiceNow will have a very good chance to grow its subscription revenue at a CAGR of 20% through 2026. I think it will be very hard for ServiceNow to maintain a 20% revenue growth each year between now and 2030. It should take ServiceNow longer to grow its subscription value to $30 billion each year. I believe there are several growth catalysts that will help ServiceNow grow its subscription value at a CAGR of 20% each year over the next several years. The first growth catalyst is this. In recent years, ServiceNow has expanded its services from its IT service management, ITSM, to many workflow applications such as IT operations management, operational technology, HR service delivery, workplace service delivery, customer service management, sales and order management, app engine, and these finance and supply chain workflow applications here. Based on what I know, many customers tend to use ServiceNow's IT service management first. ServiceNow is most well known for its technology workflows, specifically its IT service management. ServiceNow's customers tend to buy more products over time after they see a lot of value in ServiceNow's Now platform. ServiceNow only targets large enterprise customers and government agencies that have at least $100 million in revenue and a minimum of 1,000 employees. I think this is a great competitive advantage for ServiceNow because these large enterprise customers and government customers tend to have very deep pockets and large IT budgets each year. Their businesses are also very sticky once they use many workflow applications from ServiceNow. ServiceNow often upsells customers more workflow applications once customers see a lot of value in ServiceNow's Now platform. This is why I believe ServiceNow will have a very good chance to grow its subscription value at a CAGR of 20% each year over the next several years. I want to show you this product roadmap here. I believe this is another growth catalyst for ServiceNow. ServiceNow releases new major products updates twice a year. ServiceNow only started introducing its generative AI tool called Now Assist in September last year. Going forward, ServiceNow is planning to expand its generative AI tool Now Assist across all its workflow applications. Here's the important part. ServiceNow's Pro Plus package, which includes generative AI tools, will have higher pricing compared to the Pro package. This means ServiceNow will likely start generating more revenues from generative AI tools going forward. This is the third growth catalyst. ServiceNow is expanding to these major industries including retail and hospitality, financial services, healthcare, manufacturing, telecom, media and tech, and of course the public sector. All these major industries need workflow automation applications. By expanding to more industries and introducing new workflow applications with generative AI capabilities, ServiceNow's management predicts that the company's total addressable market will grow from $200 billion in 2024 to around $275 billion in 2026. Of course, ServiceNow will only capture a very small percentage of the total addressable market or TAM. But this expanding TAM suggests that ServiceNow will still have a lot of growth opportunities going forward. Based on what I know, ServiceNow is still underpenetrated in many industries. ServiceNow is planning to expand more in the international market going forward. I want to show you this recent interview. It shows that ServiceNow still has a lot of growth opportunities going forward. ServiceNow COO said this. At the highest level, being a workflow automation company and being a platform company is definitely something that is resonating with our customers. And when you're a platform company that provides many core services via a single platform, whether it's for IT or whether it's for customer operations or whether it's for employee experience, what's happening is we're also a consolidator of many point solutions. So when somebody chooses ServiceNow initially, we may replace a few point solutions on ServiceNow platform. But as they expand their use cases on ServiceNow, we see more and more point solutions being consolidated, or sometimes it's an additional spend where we become a system of action on top of multiple systems or multiple clouds that a customer may be using. And that phenomena in itself has allowed us to grow consistently north of 20% for the past few years. Our big opportunities are still international. We are in 8,000 plus companies based on a 100 million revenue threshold and 1,000 employees that are probably close to 30,000 companies that split that profile. So we basically have a 70+% opportunity in the new logos, right? New logos means new customers. 70% that do not use any ServiceNow product, any workflow, and they're in the UK, they're in India, they're in Singapore, they're in Korea, they're in Germany, they're in Central Europe, they're in Saudi, and all those places. So we're going to systematically grow more new logos or new customers internationally while we're still growing in the United States. This consensus revenue forecast is from Seeking Alpha. In terms of revenue estimates, ServiceNow's revenue is expected to grow slightly over 20% each year over the next 3 years. This matches management's 20% plus CAGR guidance. Starting in 2027, ServiceNow's revenue growth is expected to slow down slightly, but its revenue growth should still be in the mid to high teen range. In terms of EPS forecast, ServiceNow's EPS is expected to grow 20% plus each year over the next several years. I think these growth forecasts are reasonable based on management's revenue guidance and the long-term prospects I talked about earlier. Let's calculate ServiceNow's intrinsic value. I always use this intrinsic valuation model to calculate each stock's intrinsic value. You can use it to calculate ServiceNow's stock's intrinsic value, so you will know when ServiceNow becomes undervalued, fairly valued, or overvalued. If you want this intrinsic valuation model, you can download it from my Patreon blog. The link is in the video description. These are the key assumptions in this calculator. First, I define ServiceNow's intrinsic value as its future free cash flows discounted to the present day. I use the discount rate of 11% here. You can use a higher discount rate here if you want to be more conservative. Based on the long-term growth prospects and the biggest risk I talked about earlier, I believe ServiceNow's revenue will grow at a CAGR between 17.5% and 22.5% each year over the next several years. I believe this growth forecast is reasonable. I'm using a 30% free cash flow margin here. I believe this is reasonable because it matched the company's free cash flow margins over the past 3 years, which were also around 30% each year. Let's go over these 3 case scenarios: worst case, normal case, and best case scenarios. Under the worst case scenario, we're forecasting that ServiceNow's revenue will grow at a CAGR of 17.5% over the next several years. Then ServiceNow's intrinsic value should be around $134 billion for the entire company, or $643 per share. I'm giving this scenario a 25% probability here. Under the base case scenario, we're forecasting that ServiceNow's revenue will grow at a CAGR of 20% over the next several years. Then ServiceNow's intrinsic value should be around $147 billion for the entire company, or $708 per share. I'm giving this scenario a 50% probability here. Under the best case scenario, we're forecasting that ServiceNow's revenue will grow at a CAGR of 22.5% over the next several years. This assumes that ServiceNow will start earning very consistent revenues from generative AI going forward. Then ServiceNow's intrinsic value should be around $162 billion for the entire company, or $778 per share. I'm giving this scenario a 25% probability here. If we add all these numbers here, ServiceNow's intrinsic value should be around $709 per share. I also used the forward sales valuation model to estimate ServiceNow's intrinsic value, which should be around $175 billion for the entire company, or around $839 per share. If we take the average of both valuation models here, I believe ServiceNow's intrinsic value should be around $774 per share. Just to compare, Morningstar gave ServiceNow a slightly higher fair value of $790 per share. This means I believe ServiceNow is either fairly valued or still slightly undervalued at the time of making this video. This is very different from the forward P valuation method I showed you earlier. So will I buy ServiceNow stock? At the time of making this video, I don't have ServiceNow stock in my stock portfolios. Going forward, I will likely start a very small position and buy ServiceNow stock if it's still below my intrinsic value estimate. There are several reasons. First, I believe ServiceNow is one of the best SaaS businesses that is growing much faster than the industry average. I believe ServiceNow can grow its subscription revenue at a CAGR of 20% over the next several years because of the long-term growth prospects I talked about in this video. I think ServiceNow is a much better business than Salesforce and Palantir. If you look at ServiceNow's expected revenue growth rates, increasing profits, increasing free cash flows, and high free cash flow margins. ServiceNow's revenue growth is mainly driven by organic growth. The company does not rely on large acquisitions like Salesforce. ServiceNow can often upsell more workflow applications to its large enterprise customers and government customers. I believe ServiceNow is still underpenetrated in many industries and the international market. Now, these are only my opinions and my analysis based on my research. They are not financial advice. There are always risks associated with investing. It's very important to invest in what you know and not speculate. You will need to do your own research and do your extra due diligence first before investing in anything. Thank you for watching this video and supporting our channel. This is Victor from the Intelligent Investor channel, and I will see you in the next video.